short delay while we find some microphones.
Because I was not in the previous loop of email, so I lost the brief. But I assume that. But maybe it's not this.
This discussion panel focused on private equity in Africa. So in terms of private equity activity, a total value of $7.4 billion was invested last year in about 430 deals, which is a record high in the continent. With such remarkable PE growth, we are left wondering where the smart money is investing. And it's precisely in this light that I'm very pleased today to be the moderator in this panel with Africa's experienced investors to answer this question. So joining us today, we have we have Christophe Demonti, who is an investment associate at Beyond Capital Ventures, an impact venture capital firm focused primarily on the financial services, livelihoods, distribution, and mobility sectors. Christophe previously worked as a management consultant for 10 years. We have then Hashim Egonjobi, I hope I'm saying it right, managing partner of Octera Capital, a venture capital firm based in Lagos. Hashim has over 15 years experience in tech, banking, and finance, leading multinational teams and organizations across Africa, Germany, the Middle East, and Asia. We have then Mujahid Hassan, the co-head of Hybrid Equity, a business unit within Old Mutual Alternative Investments, one of Africa's largest private equity alternative investment managers in private equity, impact investing, and infrastructure funds, which is established in South Africa. Mujahid has over 12 years of financial services and operational experience. And then we have Hisham Omizin, Managing Director and Business Unit Partner in the RISE Fund, a global impact fund funded by PE firm TPG. Hisham has over 14 years experience in private equity and investment banking, spanning multiple countries in Europe, Asia, and Africa. And finally, we have Ababakar Diao, who is Managing Director of Impaxis Group, an independent investment bank in Senegal. Ababakar has over 15 years experience in corporate finance and investment banking across EMEA. So without further ado, let's start. So first, I would like to ask the panel, one by one, to very briefly describe the definition of smart money in relation to their experience in Africa. So Christophe, let's start by you.
Absolutely.
Thank you.
Well, thank you, and welcome everyone to the panel. So I'll start with maybe a more academic definition of what smart money is, right? It's money that's invested into investments that will maximize risk-adjusted return. But I think the key to why it's smart is that you're always taking into account ever-changing market dynamics. With a continent as vibrant and changing as Africa is, that's the only way that you will invest your money smartly. And so I hope we can explore some of those topics as part of this panel.
Thank you.
Yeah, it's a pleasure to be here today. Thanks for having me. So I think when we look at smart money, for us, the definition certainly goes a little bit beyond that maybe, taking into account sort of the triple P aspect, and that is in Africa, something that we really do always need to take into consideration. So we've got people, profits, and planet. In Africa, we've oftentimes maybe not had the fancy terms for it, but very much a lot of the investment that goes into Africa most times always has an impact. It may not be deemed as impact investing, but there is certainly always a social and environmental, oftentimes, and economic impact.
Thank you.
Thanks. Hi, everyone. So we're a bit different to traditional private equity. We are a mezzanine finance business, so we focus a lot on downside protection. So we look for businesses with strong cash generation, strong barriers to entry, defensive in nature, your typical Porter's five forces, and businesses that can withstand various different crises, such as financial, political, and pandemics such as COVID. And through our experience in the last 17 years of operating this business, we've managed that business through those different crises and still managed to deliver an exceptional risk-adjusted return to our clients.
Thanks, everyone. Great to be here. I think they're all great definitions. Just to be additive from our perspective, I think we over-index on the dual kind of nature of the return from impact perspective, but also providing returns to investors. And just to be additive, the one aspect I'd like to highlight is smart money has the ability to actually see a situation, unlock a situation, and the third one, adding value in the situation. And sometimes, being a great partners for the entrepreneurs to help them build, a vision as big as their dreams or sometime bigger.
Thank you. So I think the precedent definition is quite exhaustive, but what I could add is when we talk about smart money, first part maybe we're talking about the investor perspectives. Maybe for the investor that will be the return with a significant alpha. I think also when we put smart on this being an investment banking side, so both the investor, the issuer, and the client, the demands, I think the part smart may also try to solve, if we put the context in Africa, solve some structural problem we have. And also another thing we can understand by smart money is the fact that we are talking about capital market on a global way is the way where we have to structure the finance or the structure of this economy of tomorrow. So we need, in the context of when we talk about smart money, to see what are the structural needs we have for the continent, for the development of the continent, for poverty reduction, job creation, the place they have to play in the world. And also, we cannot put apart the fact that we need to have something that could be profitable. So what are, maybe it will not be the main focus, the enablers, if in the case we have the impact side, we have the needs, and maybe we don't have the right returns. So it depends.
Thank you. Well, thank you all for setting up the scene in terms of how we define smart money. Diving now more into the type of alternative equity investment that you make, I would like to ask what makes a good private equity or a venture capital firm. So let's start maybe with Hisham for private equity. What makes a good private equity firm?
Yeah, I think I'm going to kind of come back to the concept of kind of good risk-adjusted returns. But I think I would start, the first point for me is having an angle. And that angle sometimes could give you a situational advantage in terms of either unlocking the deal, which is, we've seen in many situations, kind of knowing the family, knowing the promoter, enabled to be a trusted partner and that has a lot of value. In other instances, really understanding the sector super well and being able to assess the risk, but also, to take me to the third one, being able to kind of add value. And that value add could come either from a really good sector understanding and being really a great thought partner to the CEO, to the founder, to the management team, or sometimes could be a much more meaningful value add in terms of M&A and so on and so forth. And last but not least, a functional value add, which is sometimes being a great partner in terms of helping in some aspect of the strategy, internationalization, digitization, and so on and so forth. So, but I think the bottom line here is I think there are kind of many arrows at a bow, and I think every investor will tend to kind of focus on few or actually have all of them, but tailor these few to the situation. And the art of the trade is how to pick the good arrows for the right situation to kind of create a win-win between kind of sellers and buyers sometime, or just from an impact and return on the other side.
Yeah, no, sure. And what about the VC, Christophe and
Absolutely.
Yashim?
Yeah, so from a VC perspective, obviously within the deal timeline, we're obviously earlier. So when we look at early stage companies, you have to take on a lot of risk. And so we have talked about that. We've talked about calculated risk. But to be able to find those companies, you really have to be, from a VC perspective, you have to be intellectually curious, right? A good VC is intellectually curious. They're always looking for what the new thing is. They're always looking for what the emerging trends are, right? And tying into that, and I mentioned this a little bit earlier, but a good VC is also dynamically oriented. They are always changing their perspectives. What I know yesterday is not what I'm going to know tomorrow, right? And so if I'm not updating and keeping track of how these trends are changing, I'm going to fall behind the times. And so from that, you're able to understand what the trends are. You then need to, have a high degree of stamina, right? As a VC, you see lots of companies. And so to find the diamond in the rough, it does take time, and it takes effort, and it takes, the ability to really pour through information. And then once you have that, company that you want, you have to take that calculated risk. Early stage companies require risk takers, and they require people to make that investment. You have to know that the company that you invest in today may not be the company that it's going to be tomorrow, right? When you look at those trends, many companies are launched and they change their product over time. You look at some of the big players who have changed, Jumia, Copia, right? They did not start as e-commerce companies. They grew into that, and they captured that market share. And then from that, and a little plug to Beyond Capital, you have to provide beyond capital, right? You have to give a little bit more, right? So as VCs, one of the biggest things that we provide other than financial resources is access to experience that we have in the market. It's access to our network that we can provide companies. It's access to expertise to help them grow and find their product market fit. And from all those components, you can help a company grow. And so if you're not really looking at it from a holistic perspective, you may not be a successful VC.
Yeah, Christophe, I think you've made a very good, kind of points for the VCs in the room, and I would like to touch on sort of the last aspect of what you were talking about. At Octera, that's really what we're about, and we look at value on the two sides. How do we add value, and what is the value that we're building together with the founders? In Africa, a lot of times entrepreneurs are really addressing systemic challenges and doing so with incredibly innovative, oftentimes, tech or tech-enabled solutions to ensure that we can drive the prosperity on the continent. As an investor, especially in the early stages, we've really got to look at, well, what is the value that we're trying to drive here? But what is the value add that we can then bring onto this investment? And I think as a VC, that is sort of what makes a good VC, to not just write tickets and then say, okay, hey, good luck, see you in a year, but actually to say, okay, when we do write this ticket, how do we ensure that we have some strategic, value that we can add? How do we ensure that we can ensure that we plug into the networks, that we can ensure that there's technical assistance, that we can ensure that there is, in fact, as we go into the future fundraising rounds and the growth and the scale of the company, that there is that, wider network of friendly investors that we can tie into and that we can plug into. But sometimes it goes beyond that, and also, it is also about how do we ensure that we're on the right path, right? So there is a lot of strategic advice and sessions that need to happen. Sometimes it can be very technical in financial modeling, or just sitting and saying, hey, what do you need today? How do we actually roll up the sleeves and look at this in a creative manner? So this is really what sort of, especially in venture capital, makes a good venture capital firm and a great portfolio.
Thank you very much, Ashim. And I would like to ask Mujahid about hybrid equity and traditional private equity. So how do you differentiate with the traditional private equity to unlock value, and do you think that this type of sophisticated investment will gain traction in this post-pandemic?
So look, our focus is, like you said, on mezzanine finance and preference shares, which is basically anything between senior debt and ordinary equity, and both at the operating company level and at shareholder level. And in our view, the need for more flexible funding strategies, and more specifically flexible mezzanine and hybrid equity type products, has increased. In South Africa, we've also noted that Black economic empowerment funding and other ESG and impact-focused strategies has also been gaining traction amongst institutional investors. And globally, we've also seen mega funds looking to launch non-traditional and unconventional alternative investment products, with the likes of Apollo actually launching a very significant hybrid capital business that has done exceptionally well during COVID and still continues to do well post-COVID as well. Another driver of demand for us has been regulatory change at two large insurance companies and banks. This has constrained large institutions of deploying additional capital into the riskier part of the capital structure, which has created a shortage of risk capital in the market. We've also noted internally, after having managed this business successfully on balance sheet for many years, that we also became constrained by regulatory capital being an insurer by nature, which then limited our ability to grow the size of a portfolio. The upside, though, is what we managed to do is pivot the business into a very successful third-party asset manager and start offering the product more to institutional investors to start participating in the successes of this actual strategy. Invariably, what we also found is that institutional investors are looking for alternative investments that they can diversify away from traditional asset classes, to ensure they can lock in good risk-adjusted returns and sustainable returns for their clients. During COVID also, our experience was that companies required flexible funding solutions, and that was particularly driven by liquidity constraints. These were traditionally stable businesses with top-tier track records and strong management teams. They then started looking towards more flexible mezzanine funding and hybrid equity type solutions, compared to the then very scarce bank funding and very expensive equity funding. So we basically saw this as the missing piece of capital structure that either allows businesses to continue to operate or facilitated M&A activity that wouldn't have otherwise been possible for any number of reasons. And then lastly, from a South African perspective, there is a massive need for transformation and Black economic empowerment, and our fund has a particular focus in this space. There is a recognized need and shortage of capital for Black entrepreneurs to kind of enter into these type of transactions, and we're looking to deploy into successful transactions that will have a significant impact in this specific area.
Thank you. Thank you all for these insights. Looking now at the opportunities versus the challenges, I would like to ask now, what are the emerging opportunities that you see, and what will it take for you to access them? So maybe, Abakar, you would like to go first with these questions?
Yes, thank you, Najwa. I think let's begin with the challenge maybe. I think for the challenge, we still have the exit challenge for many investors coming in the region. Because as you know, we have sometimes some good defined plan, and the way to exit through the capital markets or the way to exit to the secondary is not sometimes very, very easy to do. The second also is, let's say, what we could call the amount of dry powder, because we have many funds coming in the region. We know that we have strong demands in terms of capital, but sometimes we don't find the right deal. And one of the challenges sometimes also is the size, because the real structure of the economy is at 90% SMEs, so not that big companies. And sometimes the funds we have in front, the ticket size is quite big for these companies. Or the companies eligible, in fact, are maybe a few. So making that, we find that there is capital raise, we don't find deal, and there is capital needs. I think there is also one of the key challenges we have to tackle. Now, in the good opportunities, just to finish on this, I think right now what we have is that we have a continent with many resources coming. We have now good generation of entrepreneurs also coming. And in some type of sectors, COVID have shown that we have the agriculture sectors, and agribusiness. When I say agriculture, I mean first agriculture, but also the agribusiness part that can have very traction and very need. In the opportunities also to seize it, what we have found is sometimes, I think, kind of some hybrid investment, more mezzanine will be more understandable or more attractive for some founder or entrepreneurs sometimes still. And we don't have enough, maybe there is the funds of my friend, and we have some other tools also coming, but it's not enough offer and structured offer on this. This is being a little bit the middleman in both sides, what we can see from buyers and also from sellers.
Okay, thank you. And looking at some specific sectors, I mean, Hisham, I know that you've been focusing a lot on education and healthcare, which are kind of topical sectors within the continent. Could you give us some example of successful deals that you've recently made in these sectors?
Yeah, no, absolutely. But I think our friend Abubakar raised some very interesting pointers here, which is the exits in Africa, and how do we make sure you build companies for exit, and that will kind of maximize. I think it's not, there is no secret that the current macro environment is very challenging. That has led some of the kind of international parties to kind of desert Africa in a way. And I think our job as investors, just to make sure we increase the probability that whatever we build is going to be attractive, and which kind of get me to what are the features, what are the characteristics that makes for good investments.
Yeah.
And I think in this current macro environment, they really need to be counter-cyclical, and they need to be bringing solutions that are affordable to provide either a better healthcare, a better education, a better financial services, a better logistics, whatever. So I think the affordability and is super important in this day and age. Second, it's really tapping a market that is not just growing, but also where there are displacement feature. Often these markets tend to be the most resilient, where actually a dollar is going to be spent. Like take the example of pharmaceuticals, for instance, but or actually healthcare for that matter. So it's much better if you actually displace a dollar that's going to be spent into the same service, but cheaper and better. Which takes me, because some of the investment we've done at TPG Rise, been a lot of kind of fintech. We're investing in Airtel Money, Cellulant, Nigo, and all these companies kind of provide for more affordable fintech services. The other one we've done in healthcare is Evercare, which is a chain of hospital in Kenya and Nigeria. And again, with the same mantra, providing affordable quality. And last but not least, our investment we just exited in called Yasamin or Holjet Group in Morocco and Tunisia. And again, this is an example of actually providing for great quality at affordable prices, which is an asset that kind of got quite a lot of appeal in the exit process, which we finalized end of last year.
Great, no, thank you. And I'd like now to hear your thoughts on ESG aspects and impact investments. I mean, we all notice the growing interest into ESG investing with financial inclusion, sustainability, all being key criteria for investors. So, I mean, Hashim, very briefly, I mean, how do we ensure that funding, for example, going to infrastructure is viable and actually enable sectoral growth?
So I think it's a really great point. One of the things that we've got to always remember is that Africa is 54 countries that are incredibly diverse, versatile, hundreds of different languages, different cultures, and generally, historically, have come together very differently. With that in mind, there is obviously a fragmentation across the continent that, sometimes when you simplistically look at it, it comes across as, oh, Africa is difficult to invest in, it's volatile, the risk is really high, the ratings, go hand in hand with that. And so taking an impact lens or an ESG lens, I think actually helps us sort of even out some of that. I will, however, say that in order to make this truly viable, we've got to take a little bit of a more patient approach. Smart money is not always quick money. And I would argue that in Africa, especially with regards to private capital that, is more nascent than in some other markets. We do need to take a little bit of a more patient approach and a strategic approach as well. So Hisham made a good point with regards to strategic exits, and you brought some examples of how you build that. And the same goes on the ESG side, right? So what is it that we're building for? Does the value stand in front of it, or are there other aspects that we are trying to solve for? And then with that, of course, we also look at gender lens-focused investing. I'm really happy to see that there is more focus these days on that. I'm sure I'm not the only one in the room that would argue that women make better entrepreneurs, right? But this obviously means that we are able to sort of focus a little bit more where the capital goes, how strategically sort of centered that capital is in the communities, and that we're building for sustainability and for the long term.
Great, thank you for these valuable insights. And looking at the exit routes, I mean, Christophe, what in your experience and made successful companies in the past 10 years in terms of return on investments?
Yeah, absolutely. So, just touching on exits, right? So I think you made a great point. Smart money is not quick money. I think what we are seeing is a general trend towards later exits. Term sheets of the past would always have, 5-year exits built into them. I think you're starting to see that extend. You're starting to see patient capital being required. You're starting to see exits after 7 years, 10 years, right? It depends on the sector that you're in. Obviously, you may be able to find an earlier exit in something that's more digital and easily scalable, like financial services, where you may have more of a delayed exit in something like agriculture, which takes the time to build and grow with smallholder farmers. I think exits have been delaying over time, and now we are starting to see some trends that are emerging in the global economy which may impact exits moving forward, right? Inflation in particular. What I think we are seeing is with the increase of inflation, obviously the U.S. has dramatically increased interest rates, which has made those treasury bills all more exciting for investors and asset managers, which has led to a decrease in fundraising and funds for alternative investments. So I think for the exit landscape, as we look forward, and some of the risks that we are seeing is delayed fundraising, delayed issues with companies being able to raise funds for their next round. So you have to take mitigant approaches. You have to oversubscribe rounds when you can. You have to increase runways for companies, right? 12 months is probably not going to cut it. 18 to 24 months is probably something that you're looking for to ensure that you have that successful exit. So your runways are extending. We're also looking at currency depreciation. So I think for investments in Africa, we have seen a rise of holding companies in the U.S., at least from a U.S.-based fund, to try and mitigate some of those currency depreciation effects that we are seeing in investments and on our exits. And then the last that I just touch on are, really it's some of the external shocks that's now facing Africa, right? Commodity prices, oil prices. We look at Kenya, for example. Oil prices have increased dramatically. The government response, let's subsidize that. Let's make it easier on our consumers. Let's make it easier on the general population. But that leads to enhanced debt. And so companies that have typically relied on government grants are going to probably start to see some of that money dry up, and you're starting to see some potential exits being affected on companies that have had larger government reliance. Needless to say, it sounds doom and gloom, but that isn't necessarily the case. I think that there are lots of opportunities within Africa as we look towards the leapfrogging that has been discussed in previous panels, and it's creating a truly unique market. And while we have seen significant exits in financial services in particular, I think that technology and that leapfrogging is now going to extend into other sectors that have maybe been overlooked. Healthcare, for example. 3% of healthcare workers worldwide are in Africa, but Africa is 26% of the global health burden. How do you change that? Technology. So I think we're starting to see that happen as well with agriculture, smallholder farmers, to get them engaged and to get them aggregated, and that's going to produce more successful exits in the future.
Thank you. Just to conclude, I would like to look at the future, and I have a question for Mujahid to start with, and actually for each one of you. Given what's going on in this post recovery, but the heavy price of Russia's war, where is the money going to go, and what is your top advice to investors from this perspective? So starting with you, Mujahid.
Sure. From our perspective, there's still uncertainty in the market, so we have to be very cautious on how we screen and select investments. We would focus generally on a specific industry and which individual companies in that industry to target, as there may be a possibility that your specific industry has been permanently disrupted, as one example. Importantly, you also need to figure out how to adapt to the new normal that now exists globally, with rapid changes in the global macroeconomic environment, and also be able to navigate these changes which inevitably comes. As our product, though, is a hybrid between debt and equity, we tend to focus on more defensive sectors such as healthcare, logistics, infrastructure, financial services, etc. So it's kind of more in the kind of mezz space.
Thank you. Ababakar, top advice to investors, for the future.
Exactly.
In terms of.
I think to be more patient sometimes, because as it has been previously said, it's a 54 countries. So I think there is a good dynamics, but that may take a little bit time for different reasons. I think also for the investors also to better assess and to the equity story that they have to buy in. I think it's important also, and as I said, sometimes we have, and this is one of the problems that we found in the exit, because people, they can have very good companies, they would sell it at the best value, and the investor, what they are looking for is also, what is the next step, where are we going? Is it just an exit for a cash out, or is it an exit to build development of the companies? So I think this is some of the main point, and the other one are related to more global, it's more the regulatory effects that they have to pay attention, but also help to in the lobbying in order to help the political decision to have the FX problem, but also the monetary policy for flying in and out.
Hisham?
Well, look, it's a broad question, and I think the future will be made of the multiple initiatives of venture capital, private equity, entrepreneur. I don't think there is kind of one size fits it all. Mm-hmm. But if I kind of have to maybe put forward what matters most, I think in this day and age, specifically with the new macro environment, I would say probably two things: unit economics making sure that whatever is being done responsibly with the capital of investor. We've seen over the last kind of few years a number of great initiatives wanting to solve problem, but the reality is they can't get the unit economics to work. And I think one need to be realistic on the ability to kind of fund innovation and fund losses in the African continent in this moment. I think there was a lot of exuberance over the last kind of two to 3 years or even more, which is not here today. Yeah. So I think that would be kind of my first thing. My second would be going after a very large market. Because the reality, and if you look why the sector grew, outside of Africa, I mean, Asia and America, Southeast Asia, China, because there was always a massive market. So I think my tendency would to be, and I think this would apply for VC and for private equity, for products and services that could be applied to different markets with kind of minimal changes or minimum adaptability that provide you for kind of broader addressable market, that provide you with the kind of the size that could sink on your development cost, your R&D costs and management costs or whatever, but also to your point, will give you a much broader optionality on exit, because I think we're seeing more and more now companies and funds looking for kind of pan-African companies to kind of mitigate single country risk, but also to kind of, offer, if they are strategics acquiring, offer kind of an expansion into a much broader market rather than going at it one by one.
Yeah, definitely. And Hashim?
It's interesting. I would probably disagree with you, Hisham.
It's great to have one I think this deserves a clap.
So this disagreement is not on the unit economics. I 100% agree with you. The disagreement, I think, is in how we look at the markets. In Africa, we do have, 1.3, 1.4 billion people. 2050, we're going to have 2.25 or something like that. Huge market. But the question is, can the market afford the solutions that we're building? So to truly understand what is the solution that I'm building, who is my real target demographic, how much money do they have in their pockets? I think so that's for the founders, as you're building solutions. And I think for investors, what we need to look at is to say, as these founders are building these solutions, how do we make sure that there is, in fact, that big picture of how do we ensure that the prosperity of Africans in Africa actually is increasing? Because that is the only way that we will make sure that the markets, in fact, will be big and that the unit economics will make sense. So I think that is a really big one to look at, which is why patient capital, again, is important, right? To say, okay, we understand that some of these solutions may look like digital solutions, but there is a huge infrastructural component necessary to make them work, in fact. Looking at that, then sometimes when you're looking at it, you're like, okay, well, these guys aren't going to be profitable for how long? This doesn't look like a good investment, on the face of it. So it's really to understand the markets, to really understand, okay, well, what are the driving forces behind it? What are some of these projections? How do the currencies, look like? But to also understand that, markets are cyclical, and Africa is no different to that. So, yes, we've seen a lot of volatility, especially in, recent times. Sometimes there's a lagging effect in these things. So let's understand that, look, the lagging effect may be happening for Africa, but that doesn't mean that the cycle won't, have the upturn again. So.
Yeah, I mean, private equity view, VC view, it's always...
Yes.
So, Christophe?
I think a lot of great points have been brought up here, and I want to touch on something you said, right? I think when looking for impact, that helps you identify your biggest market, right? The most unserved and unrepresented people often have some of the biggest needs. And so it's coming up with the solutions that are able to support those needs and create that impact. And I think you'll find a lot of success there. And I do think it is taking into account tailoring solutions that are able to access those people, right? The unit economics. You have to make it accessible to them and make sure that they're able to pay for it, which I think is changing in Africa. We've always invested in the big four: Egypt, South Africa, Kenya, Nigeria. It's extended in maybe East Africa, the bloc into East Africa. You're seeing investment in Uganda, Rwanda, Tanzania. You're seeing investment in other West African nations. But when we look towards the future, who are some of the areas that have been underserved and underrepresented? Central Africa, the DRC, 4th largest population in Africa. Many, many unmet needs and an extremely large market share that can be captured. And it hasn't been targeted, right? So I think we're going to see expansions out of the big four. We're going to see better opportunities, more accessible opportunities in markets that have previously been untouched.
Thank you, and thank you all for this optimistic discussion, insightful discussion. I would like now to open, we have about 5 minutes left, so I would like to open the floor to any questions that you might have. Yes? The gentleman, please.
From African Capital Markets News. Sorry. I was wondering, in terms of exits from funds, I know this is jumping ahead for a panel this afternoon, but how do you see the capital markets? Are they out of the picture? Are they too illiquid? I've seen headlines about that. What's the pattern for you guys when you're going into investments? Where do you see the exits?
Thank you. Anyone would like to take this question?
Yeah, I'm happy to take. Look, I mean, the capital market are not going through a great time, and Africa is no exception. So I think that's kind of just the short term. I think in the medium to long run, probably the past is the best indicator, though, I mean, there is a paradigm change of what's happening. But if you look at the past, many successful private equity deals got their exit through local capital markets. Egypt has been a standout for a number of reasons. South Africa to a less extent, but still people were able to get through some IPOs done. Tunisia in a kind of 10 years back. Morocco up to kind of last year provided some good liquidity for private equity. And I think we've seen also London Stock Exchange being a contender for large Pan-African companies. And I think that will continue to be the case, but even NASDAQ for some of the tech companies. So I think public market will always remain an important part of the thinking, and I think it should be. Whether this will offer the best kind of, I'd say, exit, I would say as investors, it's probably difficult to rely on it 100%, but I think it should be part of the solution set. And we are all hopeful that the public market kind of continue to evolve, because I think that will be a very important venue to finance kind of not I wouldn't say innovation, but growth of companies going forward.
I think we had another question here. Yes, go ahead. Yeah.
Thank you for a great panel, great discussion. I'm Evelyn Dior, I manage Big Capital. We invest in women-led SMEs. I really like the point that you made about smart capital being all about creating value. So my question is for the VC investors, how do you structure and scale your value creation? Because you're known to have larger portfolios than the PE investors.
Thank you.
So I think it goes back to one of the points I was trying to make earlier, which is about both the founders as well as the investors have to be strategic around the investment, right? So as a founder, when you're speaking to investors, do your homework and understand exactly what kind of an investor it is and how can they add value to what you're trying to build in the end of the day, and how you're trying to scale. But I think as investors, it goes vice versa as well. So investors should really look at the portfolio or potential portfolio companies and say, well, how do I add value to you and your growth, and how do I ensure that we can scale together? It's not good enough to, as I said, write a ticket, walk away, but we've got to make sure that, okay, we actually have the team to be able to support you, right? So if I'm a solo GP with no team, I may not be able to say I've got 50 portfolio companies and I'm supporting everybody in the same way, right? So I think we've got to be realistic with the expectations. Of course, look, there's limits to what everybody can do. There's only so many fees that you can collect in order to do what you'd like to do. But I do think there's a big part about collaboration. On the continent, we can collaborate so much more. I don't need to know it all. I can reach out to Christophe. He's got people who may be able to help out. There's lots of great accelerators and incubators who have lots of access to funding. So we've got to collaborate, we've got to put our hands and say, hey, this is what we're looking for, and people will actually jump to it and make sure that we all succeed.
Yeah, and I just want to add to that, and I think we have to innovate, right? To scale with our portfolio companies. So an example I can give you, we launched something called Equitable Ventures. Essentially what we do is try and align our interests with that of our portfolio companies. So we give them carry in our fund once they become a portfolio company. It is now aligning our interests. As we grow and we exit companies, they get a return, right? It provides them additional assets to support their company. It decreases the extractive capital aspect of venture capital and PE in Africa. And it creates that alignment so that we can both have a shared vision moving forward, right? These are changes that will come to the industry, and these are changes that we can push for to provide things that we typically have already done, like technical assistance or pro bono company support or modeling and other services that we provide. So I think that innovation piece is the way that you can scale and make sure that you kind of continue progressing with your portfolio companies as well.
Thank you. So I think on this note, we will wrap up here. So just to say, it's obviously time for Africa to drive its continental development, to collaborate together. After all, it's the only region on the globe where more men and women decide to become entrepreneurs. So immense challenges there, but equally huge opportunities. Thank you for a great panel, great diversity of background and expertise. Thank you to AFSIC and to the audience, and enjoy the rest of your day. Thank you.
I didn't do very much.
That